So one of the biggest bulls on Wall Street just shared a little bit of a bearish message today on CNBC, and I want to go ahead and play this clip from Tom Lee talking about his thoughts for the month of September and also going forward.
I think investors should be cautious for the next 8 weeks. Market's been up 7 of the 8 months this year, so we know it's an incredibly strong market, but we also have the September cuts and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip. Good.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. I think we should expect turbulence. I would just say at the bottom line is it's a strong market, so I don't think we've seen the top for 2024. It's just that the next 8 weeks are tough.
Now, one of the things I mentioned just last night for those within the Push and Profit private group was the seasonality aspect of September. For example, we see that historically, September sees a lot of volatility, and that's due to several different reasons, right? We're coming off of summer where there's a lot of fund managers from Europe that go on vacation and then they come back and they exit their positions, a lot of mutual funds and their fiscal year. I mean, it goes on, and there's several different reasons that kind of contribute to the September effect. But I also wanted to highlight this chart right over here, how September historically does in an election year. Now, we still see a lot of volatility for September, but one thing that's pretty interesting is that in an election year, we tend to see that also bleed into October, which is a bit concerning. So we may actually have exactly what Tom Lee is saying, those 8 weeks where we see some pain in the markets. Now, taking a look at the S&P 500 from a daily perspective, we already see a big red candle for September. So it's kind of like, all right, adios summer. Here's September, welcoming the fall, where things are gonna likely fall down. Now, I want to also go ahead and talk about something else, because Tom Lee also mentioned that we had a lot of positive months for this year. I mean, if we go ahead and look at how 2024 has looked, it's been a lot of months where we actually push higher. And so having that correction like Tom Lee is suggesting won't be necessarily a bad thing, because at the end of the day, markets just can't go straight up for eternity, right? We have to have those ups and those downs. And I agree with Tom Lee that this may be an opportunity to go ahead and buy the dip in a lot of other companies. But something else that I wanted to go ahead and highlight is that this week we have a lot of labor data coming out. We have the job openings, the JOLTS report, we have the ADP employment numbers, initial jobless claims, and then of course we have the US unemployment report. And those are really going to be the main drivers for what ends up taking place for the markets, because one of the things I always say is that the labor market is the bloodline of the economy, and we're not really truly in a recession unless people lose their jobs. Because as long as people have their jobs, even if they're struggling paycheck to paycheck, the economy could keep revolving. But once you have an area where people start losing their jobs, well, now you can't go ahead and spend and contribute money into the economy. You're not going to go ahead and buy those new Nikes when you don't have a job. There's going to be a lot other, there's going to be priorities that are going to be shifted. And so that's one of the concerns, right? We're kind of shifting from an environment where, hey, inflation is high, to now, okay, inflation looks like it's going in the right trend. The trend of inflation is stifling, but what about the labor markets? And so that's something that I believe the Fed is going to go ahead and start to look a little bit more closely on now, especially because we're close to their target. I mean, if we're looking at a 3-month basis, we're actually doing very well with the trend of inflation. But I ultimately believe that the Fed is habitually late to the party, and they were late once again. And while it's well known that they're likely to do a 25 basis cut in September, I truly believe that they need to actually do a 50 basis point cut in September and be a bit more aggressive, because there's a high likelihood that we may start to see a lot more weaker economic activity taking place. And it may be too late before we actually see jobs start contracting. Because again, if companies stop doing well, they're going to go ahead and cut, their employees. They're going to do a lot of layoffs. And then it turns into this revolving cycle where, well, now these people don't have money. They can't go ahead and make purchases for this company. So this company starts losing money. They do layoffs. And then it turns onto this like tumbling, season where everyone's just kind of, unemployed. We had this high unemployment, and that's when we're truly in a recession. So we want to pay attention to the labor data that's coming out this week. Now, will there be an opportunity? Again, we'll have to go ahead and watch out to see what ends up taking place with the labor markets. But if Tom Lee is right that it's just for these 8 weeks, well, we could very well see kind of like what we saw in August, where we saw this deep kind of cut downwards, where we hit into this correctional territory and then immediately had a great dip buying opportunity where markets rebounded. We saw a lot of retail investors kind of panic and sell, and a lot of institutional investors actually scooped up some more shares. And so we could possibly see a replay of that same scenario, but it really is dependent on what's going on with the labor markets. Now, again, in terms of what's going on with the election, it is a very difficult time. And of course, all elections are going to be like that. But one of the things I mentioned for those within the Push and Profit private group last night is that, we have two polar opposites, right? We have Vice President Kamala Harris, we have President Trump. And the thing is, we have like this uncertainty taking place. And we always say that the market doesn't like uncertainty. We have conversations about unrealized capital gains tax and then tariffs on China. And the reason why uncertainty doesn't bode well for the markets is because this is the same example I used last night for those within the Push and Profit private group. If you go ahead and think of any other business, let's say a shoe store, an ice cream store, you can prepare yourself if you know something bad is going to happen. If something's good that's going to take place, well, that's even better. But at least you could go ahead and kind of model out plans on what you're going to go ahead and do. But when you have policies that are uncertain, well, you really can't map out how to go ahead and hedge and protect yourself. And so that's why this election season is definitely going to be a interesting one, and we're likely to see a lot of volatility, and we're likely to see that same historical trend that we've seen in the past where election years tend to bleed into October. And so that's why I kind of think Tom Lee is right, that it may be that 8-week period, but again, it really depends on that labor market data, right? Because if that data is looking bad, it's gonna be a lot worse than 8 weeks, and Tom Lee is gonna go ahead and have to reevaluate. Now we'll have to ask the magic 8 ball over here, is Tom Lee right that we're gonna have a correction take place within the next 8 weeks? Let's go ahead and shake it, and you always gotta give it a good shake, by the way. And it said, oh, interesting, certain. Wow, that's a bit concerning. But if you believe that the labor market's still going to go ahead and hold up, then this is definitely going to be a buying opportunity if the labor market holds up. And so we'll definitely have to go ahead and see what ends up taking place. Now, just a friendly reminder, if you have not done so already, make sure to hit that like button. This way it does help out with the channel, helps out with the YouTube algorithm. The YouTube gods love it when people hit the like button. But I also want to go ahead and talk about one more aspect. For example, just today we had Wells Fargo, the economists over at Wells Fargo, highlight how, the total construction spending has declined in July. And they mentioned that lower interest rates should eventually help bring about a turnaround. However, ongoing weakness in the forward-looking Architect Billing Index, the ABI, suggests a material recovery is still off in the distance. And so that's a bit concerning, because maybe Tom Lee is wrong, and maybe this correction could extend way beyond the 8 weeks. And so we'll again also have to pay attention to what's going on with construction. And this is why, I also mentioned that even though we're looking at equities, we have to also pay attention to what's taking place in the housing market as well, because that's just another kind of contributing factor to what's going on in this economy. But just wanted to provide an update on what Tom Lee, arguably the most bullish individuals in the market, suggested or mentioned. And he mentions kind of a bearish message that things are likely to be bearish within the next 8 weeks, but it could be a buying opportunity. I'm just saying it really depends on the labor market and the economic data we end up seeing. But with that said, guys, hopefully you guys enjoyed this video, and I'll see you guys on this next video right over here. Take care, guys.